Welcome to Invest Well, Be Well, a podcast for wiser investing and stronger living. I'm Rusty Vanneman, longtime investment professional, and I'm joined each week by my co-host, Robin Murray.
Thanks, Rusty. I'm a storyteller and journalist, and I am so excited to explore the ideas, insights, and people shaping the intersection of performance and purpose.
This podcast is for thoughtful investors and driven professionals who want to grow in their portfolios and in their personal lives.
We'll talk long-term investing, behavioral finance, personal development, and what it takes to live and work with intention.
So let's get started. Let's invest well and be well together.
This podcast is brought to you by Main Management LLC. Since 2002, Main has been recognized as an ETF strategist that combines an institutional process with the personalized service of a boutique firm.
Invest Well, Be Well is also sponsored by State Street Investment Management. Founded as a pioneer in ETFs, State Street Investment Management, through its SPDR brand, brought the first U.S. ETF to market with a SPDR S&P 500 ETF trust, commonly known by its ticker symbol, SPY.
Our guest today is Fritz Folts. He's the managing partner and chief investment strategist at 3Edge, and another great interview, Rusty.
I know, absolutely. Fritz is one of those rare investment professionals who brings together deep institutional experience with a disciplined process and a behavioral awareness. And I think that's a combination that's essential for long-term investing success. At 3Edge, Fritz leads the firm's global multi-asset investment strategy, which is research-driven, model-based approach designed to deliver consistent returns while managing downside risk. In fact, risk management is one of the cornerstones of his philosophy, and that focus is as important today as it has ever been. As Fritz says, markets may change, but the need to protect capital and stay disciplined through uncertainty never does. Before 3Edge, Fritz spent decades working with institutions and private investors alike, helping them navigate markets, building durable, resilient portfolios, and making better long-term decisions. You might recognize his voice from View from the Edge. It's the firm's monthly commentary and podcast, where he breaks down global market dynamics with clarity and conviction. I've known Fritz for years. He's insightful, high energy, and he's genuinely passionate about helping investors stay both wise and steady. What were your takeaways, Robin?
Well, as you said, Rusty, just another great interview. So much wisdom packed into that 45 minutes or however long it was. We talked about, some timeless investment principles, one of which is there's nothing new under the sun. And, taking a look at where the market has been to understand where it is now and all those market cycles, which I just thought was really interesting. He also talked about considering yourself an investment athlete when he was talking about stronger living and balancing that work-life, creating that work-life balance for yourself. And I shouldn't be surprised for so many interviews that we've done, but it's just amazing to me how often we hear from our guests about the importance of balance in work and life, caring for yourself physically, mentally, emotionally. And this is just such a high-paced, high-pressure industry. It's kind of surprising how often our guests just totally understand that, totally have their feet on the ground in terms of what's important and how to really achieve success. That's got nothing to do with data and markets.
Right. I did like his comment about being an athlete as well, because I guess we kind of all are, even if we're in the investment industry or not. Again, so many words of wisdom. He's been in the industry for decades, and he's not slowing down. I do need to give a shout out to his firm, 3Edge, as well. I mean, it's one of these smaller, boutique, emerging firms that have a distinctive investment approach. It's a reliable approach. They clearly say what they're doing. They partner really well with other asset management firms, and they work really well with financial advisors, and all of it is for a great experience for investors. And I think that all comes through on this interview.
Great. Let's listen. All right. Well, Fritz, welcome to Invest Well, Be Well. It's so good to have you on the show today.
Thanks for having me, and congratulations on the new gig. I think it's great.
Thank you, Fritz.
Thank you.
And thank you for being a guest on Invest Well, Be Well. Of course, you were a guest on our prior podcast, and one tradition we have brought over to get the fun started is we need a walk-up song to set the tone for the interview. What is your walk-up song for today's interview?
Well, it's a little out of character for me, but I just got off of a Peloton workout, and my Peloton trainer that I like is in London. She's in the UK, and so she has a lot of UK music. So my walk-up song is Bulletproof by LaRue, which is a UK synth pop artist, and the song is actually from 2009. And it's a little different, but really like it. It's a great Peloton song. So I will go with that for my
I had you completely pegged as a synth pop guy. There it is. Here's the press.
It's written all over me. Yeah. Yeah.
That's awesome. All right. Well, Fritz, it's so good to see you again. Please tell us about 3Edge before we get started and the work that you do there.
Sure. So 3Edge was launched in 2016, but the story of the firm goes back to the early 2000s. We had a predecessor firm called Windward Investment Management. I was actually the fourth employee at Windward. When I joined in 2002, we were able to grow the firm from just over $100 million to almost $5 billion, and we ultimately sold to Charles Schwab. But the core of our research team and investment committee, we stayed for a transition period, then we left, and we started to put together 3Edge, which we eventually launched in 2016. So the core of the research team and the investment committee, we've worked together now for the better part of 2 decades. And the way that we invest, we are tactical, multi-asset investment firm, which simply means we're investing across asset classes, stocks, bonds, real assets such as gold and commodities, as well as cash and currencies. We invest across geography, Europe, US, Europe, Asia, Far East, and the emerging markets. And we're considered to be tactical investors because we're making changes to our portfolio as our outlook for the market changes over time. We don't invest in individual stocks or bonds, but we construct portfolios through ETFs, and all of our investment research is done through our proprietary model of the global capital markets, which is based on over 40 years of studying what we consider to be the true cause and effect relationships that drive markets over time. And so we combine tactical and broad asset diversification. And I would describe our approach really in many ways. It's a safety-first strategy. It's often considered a diversifying strategy. And that's because our portfolios tend to have a consistently low correlation to both stocks and bonds. And therefore, they have a low correlation to other investment strategies, which is why our portfolios can work well as part of advisors' mixed model portfolios. So I would say that is a summary overview.
As somebody who has been an active asset allocator, as I have been for many decades now, that's all music to my ears. That was almost as good as the walk-up song right there. So the first theme to our podcast is about wiser investing. So it's thinking big picture, it's thinking philosophy. So at the highest level, what would you say are, let's say, 3 investment principles that are timeless, the ones that support long-term success no matter what the market regime? And I do say 3, but of course, since you're Fritz, you can do more than 3 if you want. But
3 is fine. 3 is fine. We got that. So as we know, I mean, there are countless ways to invest in the global capital markets. But I do believe there are important principles that are, they're simply consistent. One of them, I'll start with, is playing the long game, which I heard on a previous guest of yours who mentioned the same thing, and I totally agree with that. And because it is so easy, first of all, it's very easy to look very foolish on any given day in this industry. It is. So you have to be humble. But it also means that you can't get caught up in the day-to-day and the back and forth of the markets. It's not only counterproductive, but it's really dangerous. And, I believe playing the short game is just not a recipe for success when you're trying to be a successful investor. So I would say that, to me, what really stood out as the number one factor. The other is, I feel it's important to study and understand market history. And it's not because you're studying the past, but what you're studying is changes that have occurred throughout history. But you need to balance that, because it's also important to realize that, I know that's an overused expression about our history doesn't repeat itself, but it tends to rhyme, thanks to Mark Twain. And there's a reason why we often hear this expression in the investment world. And going back in history, even beyond Mark Twain, there's even a quote from the Bible from a passage from Ecclesiastes which says what has been will be again, what has been done will be done again. There is nothing new under the sun. And basically what this is telling you is that there is a cycle to the economy and there's a cycle to the market. And so it's very helpful to understand market history. It gives you perspective when you're trying to understand what's going on in the present, because it's frankly very hard to do because you get so many different signals. I haven't read Andrew Ross Sorkin's book, 1929. I have heard him interviewed, though, and it is really incredible how many parallels from the Roaring '20s and the ultimate crash of '29 seem to be evident today in the market. The fact that the Roaring '20s and the crash of '29 followed after a global pandemic, the outbreak of the Spanish flu, is kind of eerie when you consider the current market environment coming out of COVID-19 and the global pandemic. And for third, I would say it's really important to really try to develop the capacity to hold two or more scenarios in your mind simultaneously. And don't become too wedded. Now, so we're tactical and multi-asset, so we are making maybe more dramatic changes in the portfolio, might be switching asset classes, et cetera, but you don't want to get too wedded to any potential investment scenario or outcome because the world is just so unpredictable. So to try to develop the capacity to keep two different scenarios in front of mind as you try to analyze the market. So those would be my three.
I like it. Hey, one quick side note. It was about 20 years ago, I used to have to write a monthly commentary, and for one year, every month, I incorporated a line from Ecclesiastes.
Oh my
It's
goodness.
funny you mentioned that because there's so much investing counsel in that book. So anyway, I thought it was great that you quoted that. That's pretty cool.
Right. Here's another one for you. Many investors are always looking for kind of the next big idea, right? So from your vantage point, how do you balance the pursuit of upside versus the protection of downside when building portfolios?
Great question. So our goal at 3Edge is we're trying to generate what we refer to as attractive risk-adjusted returns. And the current excitement, let's say, so AI, that could be, the next big idea. The current excitement over AI, it's a really good example of the next big idea. And there's no doubt that AI and particular artificial general intelligence, it's going to change our lives in ways that we can't even imagine yet. However, under the guise of keeping two scenarios in mind at the same time, AI will be life-changing technology, but it's also most likely creating a stock market bubble that will eventually not end well. It will eventually burst. And so there could be many parallels with the evolution of the internet, for example. You had all this excitement over the internet. We had tech stock bubble with companies like pets.com, and everybody got excited and was, investing all that they had, but it eventually burst. And it wasn't until years later that the real impact on society from the technology of the internet came to fruition. And in fact, if you think about the internet, it really wasn't until the internet gravitated to our mobile devices, to our phones, that the impact became life-changing. And so I think that it's okay to be excited about the prospects of the technology in terms of artificial intelligence, but at the same time, you need to be very cautious, particularly in here, because this market has just gotten so far ahead of itself. And it doesn't mean that it has to come to an end tomorrow or next week or even next month. But what it does mean is when it does come to an end, this market bubble, we're at such high levels that the fall could be quite steep and quite dramatic. So that's what I would like investors to keep in mind, while at the same time they're excited about the opportunities with artificial intelligence.
A lot of people playing AI, they say it's AI, but they're almost really falling for the single stock. They really like it. So, but you work obviously in a multi-asset tactical diversifier framework at 3Edge. How do you counsel investors about the importance of asset allocation versus security selection? What matters more for long-term outcomes?
So, first I would say that, we wouldn't claim that our approach is better than selecting securities. If, there are a lot of smart people out there who have the ability to choose individual companies that stocks are going to outperform, but it's just, it's not what we do. And we might say that, it might seem to us at least a little bit risky to try to do that. So yes, we're tactical, we're a multi-asset firm, and we create portfolios, tactical, broadly diversified. Invested across stocks, bonds, real assets, gold, commodities, cash, currencies, and we create these portfolios through ETFs. So I would characterize our entire investment approach in some respects as an asset allocation approach. Our job is to get the asset allocation right, when to lean into equities or whether to lean into U.S. or ex-U.S. equities, when to lean into bonds, when to lean into real assets such as commodities or gold, and importantly, when to dial back exposure, right, to other equities or other asset classes. And all of these asset allocation decisions are guided by our model. And sometimes the way I describe it is the model's strength isn't necessarily picking each of the asset classes that's going to outperform over the next 12 months. But what the model is really good at is combining all these different asset classes together to give a portfolio that has a chance to grow, but also has a very serious component of risk management in it. So we really are asset allocators, first and foremost.
All right, you just brought up risk management, so I have to ask, what do you think about the concept of risk, and particularly as opposed to the concept of volatility? What do you tell investors about real risk versus perceived risk?
Right. So for us, the concept of volatility versus risk is foundational to us. Most traditional risk measures focus more on standard deviation. They focus more on volatility. And the problem with relying too much on volatility as your measure of risk is that too often investors equate low volatility with low risk and safety, but that's a misconception, as you know. There are plenty of low volatility strategies that don't eliminate risk. I mean, you had long-term capital founded by, John Merriweather from Solomon, very famous, and Myron Scholes and Merton. And it was marketed as a low volatility market neutral strategy. So you would be insulated from directional moves. And it worked until 1998 when the Russian debt default and the Asian financial crisis combined, causing spreads to widen and long-term capital just got crushed. And so that to me is the thing that you have to be aware of. It's okay. I mean, volatility is fine. Standard deviation is a good measure of risk, but it's insufficient. Because to me, the takeaway is that tail risk, some black swan event, something that happens. Because if you're looking at volatility, in some respects, you're sort of assuming normal market conditions. But at Three Edge, risk management starts with our broad asset diversification, our tactical approach, and reduce exposure to catastrophic outcomes. That's really the difference, and it's really fundamental to what we do. We really want to focus on risk in terms of maximum drawdown and go well beyond just focusing on volatility. But it's not an easy thing to explain to investors either. So we struggle with that, and we're still working at it, but we do try to put that word out there.
Mm-hmm.
So you talked about this a bit already, but I want to ask you about your view from the Edge monthly commentary. Your September article was, "Buckle up, it could be a wild ride." So what's your current high-level read on the market, and why do you think it's different from the last 5 to 10 years?
Sure. So our model has done quite well through 2025 so far. It has had us overweight ex-U.S. stocks, which have actually outperformed U.S. stocks, and it's had us overweight gold, which has had really a ridiculous run in 2025. I think it's up like 60% at this time. But what we would say is, if you look at the market now, one of the major things that is different is this 4-decade-long bull market in bonds is well over. It ended actually probably in 2020. And it's interesting because when I talk to investors, they say, well, when are interest rates going back to normal? And I have to pinch myself and remind myself that what they mean is, when are interest rates going back to close to zero? And we would argue that, well, that's not really going to happen. So the current market environment, you have a very strong U.S. equity market, but it's really driven by momentum, by short-term factors, by investor behavior and FOMO and buy the dip and all these other things that are they're powerful, but they're very short-term. And it's holding up a market in the face of extreme overvaluations and a lot of threats, the threat of stagflation, the soaring government debt, the potential for private credit defaults. We have the highest tariffs since the Great Depression, a lot of geopolitical risk. And those are, in many respects, long-term factors. So you have a very powerful market, but it's really driven by investor behavior. You have super high valuations, lots of debt. And so there are a lot of risks out there. But the way I would describe our outlook at this point is that there are bullish factors and bearish factors out there, and they coexist. And so because we're multi-asset and have a wide array of assets we can invest in, we can play offense and defense simultaneously. So we can look for opportunities for return, ex-US equities, gold, while also focusing on managing downside risk. And so that's the way we're approaching this thing. And we are also, in our model, we have factors that we call canaries, the canaries in the coal mine. And we're looking very closely at those to see if any of those should start to signal that the market might start to crack in here. So one thing that we watch closely is credit spreads. And credit spreads have been very narrow, but they're actually starting to widen out now. Not to the extent that it's a problem yet, but that would be one of the warning signs. So go ahead and stay invested in the equity markets, but understand there are a lot of potholes out there that you need to be aware of and be prepared to take defensive action.
So you talked a bit about diversification, but how do you view the role of diversification in today's world where a lot of elements of the stock market or the market, stocks, bonds, and commodities seem to rise and fall together? So what do you tell investors about genuine diversification and how to recognize false diversification?
So there are definitely periods of time, as you said, where it seems that, correlations go to one and that everything seems to be correlated. However, there are always certain, if your quiver, if you will, has enough different asset classes in it, there are always certain asset classes that can hold their value, even go up in different environments. So with our multi-asset approach, we're always going to hold different asset classes for the different periods of economic and market cycles. So we want to have assets that can protect us if we're in disinflation, economic slowdown, or periods of overheated markets and inflation. We want to be ready if we're in an economic recovery and your stocks are going to do better. Or if you're in a period of a credit contraction where liquidity is extracted from the system and really short-term, high-quality, low-duration treasuries are what you want to hold. So what we would say is, if you're only invested in stocks and bonds, there are periods of time like 2022 when both of those assets lost value. But if you have the capacity to invest in real assets and cash and currencies and all of the other various asset classes that are out there, we feel that our diversification is so broad that it will protect us regardless of what may come in the markets. And the ETF market has helped, right? Because now there are ETFs for so many different asset classes and so many different flavors of them.
This episode of Invest Well, Be Well is brought to you by Main Management LLC, a pioneer in actively managed ETFs since 2002. Main Management starts with a clear fiduciary focus, delivering the transparency and personal attention you'd expect from a boutique firm. They provide financial advisors with solutions, not products. Main also believes investors should keep more of what they earn, emphasizing net of fee after-tax performance to help clients retain more of their returns. I've known Main Management for years. I've met thousands of managers over the course of my career, and one quality I really value: they invest alongside their clients. They eat their own cooking. Over 10% of the assets they manage are their own partner assets, and more than half of the firm are partners themselves. That says a lot. To learn more about Main strategies, including buy right hedged equity, U.S. sector rotation, thematic innovation, and all asset models, please visit their website at mainmgt.com. Well, Fritz, shifting gears to the second theme of our show, which is about stronger living. And in your role as a chief investment strategist, you're making high-stake decisions and operating under pressure. And even when your style of investing is working, some clients think you could probably still do a better job. So what routines or discipline do you use to maintain mental clarity and high-quality decision-making?
Great question. So for maintaining mental clarity, I feel like it's very straightforward. I feel like diet, exercise, and sleep. You have to have a good diet, you have to exercise, and you have to get enough sleep. The way I look at it is, try to think, if you're in the investment industry and we have been doing this for a long time, and it is a stressful environment. I want to think, the way I think about it now is consider yourself an athlete, an investment athlete. You see these, like a profile of an athlete, and you look what he does throughout the day, and gee, no wonder he's a good athlete. He's doing all these things that are good for him. He's training, he's taking care of his body, he's getting sleep. And so I really feel like that is a good approach to investing. Think about yourself as an athlete. You're not going to go win a gold medal, but you need to keep your body in shape. You need to sleep. You need to get nutrition and take it seriously, and it will really help you.
Yeah, I love that analogy. And, in athletes, professional athletes, one thing I think a lot of people underestimate is how much time they spend in recovery, repairing their bodies. It's not always go, go, go. So, okay, what about in an environment where it's a really challenging period in the markets? What do you do to emotionally regulate and avoid behavioral traps in that situation?
So this is where it's really helpful that we have our research model available to us, where you can, our model represents, it's not a black box. The model represents our theories about what we believe to be the true cause and effect relationships that drive the markets. And so because it's not a black box, if we see something strange, we can go back into the model and see exactly why it's telling us what it's telling us. But that is very helpful when things seem to just, the news is crazy, the headlines are crazy, the market may be going up dramatically or down dramatically. The model is a emotionless barometer, if you will. And so we can look at it and say, okay, there's all this noise happening right now. What does the model think about what's happening? We also have, we're old, so we have like 120 years of investment experience. So we're a little less prone to that. We're pretty good at being disciplined, but I really do like the fact that when things get really crazy, we can go back into the model and take some comfort that it's looking back over 120 years of market history and helping to guide our investment decisions.
So what about that work-life balance? How do you balance your professional responsibilities with personal time or time off? How important is that balance to your ability to perform long-term?
So I would definitely, again, I think it's this idea that in the Rusty mentioned the recovery period and how that's just as important. It's interesting in the investment business that oftentimes the best thing you can do to be successful is do nothing and to not take a move, to not sell, to not buy, but to just, let your process work. And I also think, again, I'm a little bit older, but I feel like at this point in my life, I feel like every day it's a privilege to just be, to be alive, to have a family, to have a home, to be safe, and all of these things. And I just, if you can just take time to appreciate that, there's a Japanese expression called yutori, which is just taking the time to slow down, observe the world around you, relax, and breathe. And that's really, really important in this business. And I oftentimes just walk away. I typically go for a 3-mile walk every day, and I find that to be very helpful. It's just hugely important. It's easy to get stuck at your computer. I work from home a lot, so, it's like, I'm sure this happens to you guys too. You're staring at the thing, every time you walk by it. It's so tempting to sit down and start working again. So just be very intentional about taking time away from the work. It'll make you a better investor in the end too.
So if you were mentoring a younger investor, what would you tell them about living well while building a long-term investing mindset?
So I have 3 of these. Okay, actually I have 6, but all right, here we go. So I think it's hugely important if you can find someone who can be a mentor. I think, Rusty, I'm sure you have people who you consider to be mentors who helped you, and people are more than willing to do that. Everybody wants to talk about what they do, what they've learned. So if you're young and you're getting in the business, find someone who you admire, who does things the way you think you would like to, and go ahead and ask that person if you can spend time with them and learn from them. So I think that's really important. And then I have 3 bullet point answers to that. 1, talk to yourself more than you listen to yourself. It's really easy in this business to say, oh, I'm not good at it. Oh, I made this mistake. And, You just have to get over that. You don't have time. So if you make a mistake, and what I say is we either win or we learn. It's not a new expression, but that's so true. You win or you learn. So never, never, never give up on you, regardless of what happens as you're starting out in your career. And just keep reminding yourself, you didn't come this far to just come this far. Just keep going and you'll be fine. Because in many respects, right, Rusty, just being persistent is going to get you a very, very long way because you're going to be committed.
Yeah, I like it. So I want to ask about your team. And
Right.
so recently, I enjoy talking to you, but I also really enjoy, one of my favorite people is Eric B. at your firm.
Love Eric.
And I just want to say that I was at a table recently and we were talking about Eric. He wasn't there. And everybody at the table pronounced his last name differently.
Okay.
How do you pronounce Eric's last name?
You ready?
Yep,
Beagleizing.
I was wrong. All right. Well, Eric, if you're listening, I love talking to you and working with you. But I do have a question about the team, though.
Sure.
And so many leaders talk, or they say, culture eats strategy for breakfast.
Yep.
So on your team, what do you do to cultivate a high-performance, disciplined investing culture, and how does that reflect in your personal leadership habits?
All right. So we, obviously we're a smaller firm in this industry. We're more of a boutique, so we have to compete with the behemoths out there, and so you have to look for a competitive advantage. And so we work really hard developing a consistent culture, which we describe as being externally competitive and internally collaborative. And for me, like the most critical component of a high functioning team, in my opinion, in my experience, is it demands authenticity. You need to bring your true self to work. You have to be who you are 24 hours a day and all of the time that you're at work interacting with your colleagues. You have to feel like it's safe for you to speak up. You have to say, I don't understand something. Can you please explain it? You have to be willing to say, oh, I disagree about that topic. And those aren't necessarily easy things to do. But if you can generate a culture that is really, truly authentic, then you can have your team members do that. And to me, that is like the surest way to get to a high functioning team. I just have so much respect for everybody on the team. We have people who are referred to as wholesalers, right? They're out talking to advisors. And I always tell them, you're not just salespeople. You are strategic thinkers. You're out there and you have the most important feedback to us to help us decide which direction to go. And I know that they're thinking about doing what is best for the business. And if you can just spread that culture throughout, you're going to be very successful. So I would just say that really we spend a lot of time being intentional about culture. And to me, this idea of authenticity is foundational to a really high-functioning team.
Yeah, love it.
Well, Fritz, this has been another great conversation. We so appreciate you coming on the show. It was great to see you. Before you go, tell us how can advisors and listeners follow your work and learn more from you?
Sure. So I think a good way would be to go to our 3 Edge YouTube channel. And then there's this entire library of videos, and they're short. They're 10 minutes or less. And I do those with Steve Cucchiaro, who's our CIO. He's really brilliant. And we pick a topic that we think is of interest or investors might be concerned about. We don't use jargon. We don't try to sell anything. We just want to inform people about what might be going on so that they better understand the world of investing, because we feel like an informed investor is able to make better investment decisions. So if people go to that 3 Edge YouTube channel, I think they could learn a lot about us. And if people want to just send me an email, I'd love to hear from people whether they have any interest in our firm or not. And so that my email is just dgf@3edgeam.com. People should feel free to reach out to me. And thank you both for inviting me to be on your podcasting. Once again, congratulations.
Thank you, Fritz. Hey, I have one last question. So, Robin and I have the good fortune on all these interviews, and we do this on Zoom so we can see you. So we actually get kind of a sneak peek into everybody's office. We can see what they have on the wall, their books and all that kind of stuff. It's really, really cool. And of course, you've been a guest on our prior podcast. And of all the podcasts we've done, and Robin and I have done approximately 350, my favorite painting is Behind You.
It is indeed, yes.
So again, just to set the stage, it is a little wooden sailboat. It looks like...
and you can see it, right?
Yeah, it looks like a cat's paw dinghy. It's a Herreshoff hull, and it's got a big black cow in it, probably an Angus. It could be something else. What's the story behind that picture? I just love it.
So it's painted by a guy whose name escapes me now. I bought it on Nantucket. We were down sponsoring Nantucket Race Week because Steve Cucchiaro is a big sailor. And so we were down there, I walked into a shop, I saw it, and it's just like, I have to have this painting. And I love the expression on the cow's face and how the heck you're going to get this cow in this boat and not tip it over. But it's just, I don't know. I think it's just this, so this fellow does a lot of paintings. Some of them are like the one that I have. He has one with a cow on a tightrope walking over water, which is also sufficiently weird. But then he just has a lot of paintings of the ocean. And in fact, I think he spent time living on the North Shore of Massachusetts, not sure where. So he likes to play with light on the water, but I don't know how he got the weirdness streak that he had to do these. But I just...
Well, I'll tell you why I think it's not weird and why I like it. And now that you've given some of the background, I'm thinking I know where the origin of the story came from. So years ago, I used to live on the North Shore of Boston in a town called Marblehead. Mm-hmm. And my boat looked exactly like that boat. And I had a 130-pound black Newfoundland dog that used to sit in the back of the boat.
Oh, there you go.
He always wanted to be in the boat with me. So now I can tell myself the inspiration for that painting actually was my good old Newfoundland Abby and me.
That's right. And I would never argue with you. Love it. I love it. Yeah.
Well, I love the painting. And thank you so much for your time today. As always, words of wisdom. I mean, every answer was like a nugget. So thank you so very much for your time, Fritz.
Well, thank you guys very much. Great to see you both, and hope our paths cross again soon.
You too. Thanks, Fritz.
All right. Yeah, take care.
We'll be back next week. Thanks for listening to Invest Well, Be Well. Let us know what you think. And if you like what you hear, don't forget to subscribe.
This podcast is hosted by Rusty Vanneman and Robin Murray and produced by Garrett Crosby.
If you have feedback, guest suggestions, or just want to connect, please visit my website, rustysbridge.com, or email me directly at rusty@rustysbridge.com. Until next time, invest well and be well. This episode of Invest Well, Be Well is brought to you by Bonrion Capital, led by my friend and colleague of nearly 10 years, Shana Sissel. Shana was named a top 20 wealth tech CEO in 2025, and it's no surprise. She's passionate, does the work, and knows asset managers, portfolio allocations, and alternatives like few others in the business. She's authentic, tough, and deeply cares about all her stakeholders, the kind of character you'd expect from the daughter of a police officer. If you want an investment manager who combines deep due diligence with innovative solutions and alternative investments, please check out Bonrion Capital at bonrioncapital.com.